So we are saying that break-even point, for those who are just joining, this is what we've just written. Break-even point sensitivity analysis, that is our class today. And we say that this ascertains the change in a variable that will push the project to 0 NPV. So what are we saying here? Is that we want to look at the normal, which we call the base NPV. The base NPV, you remember it? NPV at rest without any change. Then after that, we now ask ourselves, what kind of change can we make to make NPV 0? So that is why I'm saying that in break-even point, we are trying to ascertain, we are trying to determine the NPV that can make the change. We are trying to look at the change on a given variable that can make NPV 0. So we need to look at change in these variables. Variable number 1 could be the cost, maybe the price, maybe the IO that can make NPV 0. We also have something called scrap value. Scrap value, we can also have that as well, right? So that scrap value is basically the value of scrap metals. For example, ukinunua bicycle at some point inazeeka, unaenda kuuza, right? Wale watu wa mali wakikuja saa zingine wanachukua sio nguo peke yake, even metals. Now that old one that you are going to dispose, it is scrap. But here we call it a scrap value. Now when you start a project, at some point, once you've actually fulfilled your main need or aim, you can decide to dispose it. Or the machines, you can decide to do away with it, dispose it. At that point, what we are saying is that there is a value attached to that item. Those accountants who are here, you remember that sometimes you can buy a machine like a laptop. And then laptop and phones, you can depreciate them at 30% or 25%. If you depreciate a laptop at 30%, it means it will only stay for 3 years. The fourth year, it should be 0. Still, 25% will be exactly 4 years. So what if you are still having the machine or a system or your phone after 4 years? In terms of depreciation, you should have done the full value, right? But then there is a value that is still attached to it even after it is fully depreciated. Na maybe kazi yake imeisha. You still have some value and you can sell it. So what are we saying? That particular value that you're going to find at the end is also part of the money that you will receive. When you sell it, you're going to receive that money. And even if you just keep it at home, it is still an asset which has got some value in it. Therefore, when you buy a machine, at 500,000, and we are saying that you're going to depreciate it at some rate, and the scrap value will be 50,000 at the end of the period, this machine will be able to generate for you. This machine will be able to generate for you some income for the next few periods, maybe like 5 years or 10 years. Apart from that income, there is the final value that you're going to get when you sell that machine after its use has come to an end. So we have the normal cash flows from the business, and then we have the sale or disposal value, which you call scrap value. Those are all your money. And so when you are trying to value and get NPV for this machine, you are going to get the NPVs for the respective cash flows depending on the years. After that, the final year, you'll get the NPV for the item. Not just NPV, you're going to get the PV, the present value of the sale that you're going to make. So that means that if the cash flows were regular, if the cash flows were the same every year for the next 10 years, those ones you can use PV for because they are the same yearly. But in the 10th year, you remember to also sell the item and get the cash flow from it. And that cash flow is not regular. It is a one-off. Therefore, the cash flow for scrap value, cash flow from the scrap value is normally on PV, but not PV because it is a one-off thing, one-off sale, not a recurrent or regular. So we are going to look at this. Let's look at this illustration. Say illustration 1. ABC Limited. Can I write that? ABC Limited wants to buy an equipment costing Kenya shillings 500,000. ABC Limited ABC Limited, ABC Limited wants to buy an equipment costing 500,000. Wants to buy an equipment costing 500,000. Full stop. It has a useful life of 3 years. It has a useful life of 3 years, after which it will be sold as scrap value for Kenya shillings 80,000. It has a useful life of 3 years. It has a useful life of 3 years, after which it will be sold as scrap value for Kenya shillings 80,000. It will be sold as scrap for Kenya shillings 80,000. For each of the 3 years, for each of the 3 years of usage, the equipment is expected to increase both sales revenue for each of the 3 years of usage, the equipment is expected to increase both sales revenue. The equipment is expected to increase both sales revenue and operating cost by 600,000 and 400,000 Kenyan shillings respectively. I hope that it makes some sense to you. For each of the 3 years of usage, the equipment is expected to increase both sales revenue and operating cost by Kenya shillings 600,000 and 400,000 respectively. So what we are saying is that we are going to buy the machine. We are going to put the machine on use. Every year, the cost, both revenue and cost, will keep on increasing. So mwaka ya kwanza, let's say it was 600,000. In the second year, it increases again. So we are saying for each of the 3 years, the equipment cost is expected to increase both sales. The equipment is expected to increase both sales and revenue. Both sales revenue and operating cost by 600 and 400 respectively, 400,000 respectively. Full stop. The company's cost of capital is 10% and the tax rate 30%. The company's cost of capital is 10% and the tax rate 30%. The company's cost of capital is 10%. The company's cost of capital is 10% and the tax rate 30%. Tax rate is 30%. Required Roman 1, calculate the NPV of the project. Calculate the NPV of the project. So which NPV is that? Calculate the NPV of the project. Calculate the NPV of the project. Calculate the NPV. True. That is base NPV. Base NPV. So base NPV ndio NPV ya kwanza kabla uanze kuchange or kabla uanze kutafuta the sensitivity. So the first one is the NPV at rest bila kusumbuliwa. The initial NPV. Okay. So are we together? There's anybody who has missed something we need to check? I want you guys to calculate for me NPV first, and then you tell me where you have reached the NPV. Let's everyone try first. How do you get NPV? Can somebody try? Then we see who can try that before we move. The one that you have written, question that you have written, somebody can take a photo and share on WhatsApp the question so that not quitting can try it. Okay. So what are we supposed to do? You know what we normally do when we are looking at NPV. I know some of you will not even move an inch because you are still new. So I'll assist you. Then the second one you do. I say that when you're looking at NPV, ask yourself some of these questions. Number one, do you know the formula? So the NPV is equal to, let me try this other pen. I don't think this is clear. So NPV is equal to the cash flow times discounting factor, which we shall know whether it is PV or PV factor, minus initial outlay. When you talk about cash flow, we are talking about either regular cash flow or irregular. Regular cash flows or irregular cash flow. Regular cash flow or irregular cash flow. Then, if you have any scrap value, that is also part of cash flow. So you'll be able to add the regular cash flows first, cash flow from the operations, and then you add the scrap value. The total now you minus IO. So you need to ask yourself, do I know the cash flows that are available? How do I get cash flow? And it is not just cash flow. It should be a free cash flow. It should be a free cash flow. That is cash flow that is not attached to anything. You have deducted tax if available. You have also deducted depreciation if available. Are we okay? Okay, let's proceed. Look at the statement. They are saying that this material, this item or equipment will be bought at 500,000. It shall have a scrap value of 80,000. What is the examiner is trying to tell you? What is the examiner trying to tell you? That this machine will lose value. It will be depreciated at a certain rate. And that is why the value will remain 80 from 50. That difference is depreciated. So you are given the years. So the depreciation here will be on a straight line basis. So that means that you can be able to get your depreciation for the period. How can you get depreciation? Can somebody try and get us? So you start by calculating depreciation. We can say that our cash flow, initial cash flow, so write their solution. Write their solution. Initial cash flow has been given. In fact, initial cash outflow cash outflow, that is the money that you have used. Cash outflow is equal to 500,000. Then we now calculate depreciation. Because we are told that it has scrap value, that automatically means that the difference has been depreciated. So how do we know depreciation per year? So depreciation per year is equal to the total value minus scrap value, which is 80,000. That difference is what has been depreciated equally on a straight line basis for 3 years. So therefore, our depreciation per year is 42 divided by 3. 120 divided by 3 is giving us how much? Can somebody get me the figure? 140, right? Per annum. That is the depreciation per annum. Sometimes, in fact, most of the time, the examiner will tell you that the item was depreciated on a straight line basis. So just get the original value less the scrap value, because this one has not been depreciated. So how much did we write off or depreciated? 420. So if that is the total and is in a straight line basis, then we get it, we divide it by 3. So equally, every year, you can be able to get for 140,000. That is the depreciated amount. Now, after that, we now ask ourselves, so that is an expense, right? When you're getting the cash flow, free cash flow, depreciation is normally deducted, still. Yes. So we now ask ourselves, is there any information that has been given? The company cost of capital is 10% and the tax rate is 30%. Whenever, and listen, whenever you are given tax, just know that you always tax after depreciation still. Whenever you're given tax, you need to know that tax is normally deducted after depreciation. So you have to depreciate it. If you are not given tax, forget about depreciation, because there is no difference. There is no implication or there is no effect. Because when you talk about cash flow, we are talking about actual money that has left your bank account. Actual money that has flown either in or out. We are not talking about the theories. That is why it is the cash that is flowing. So why is it important to look at depreciation whenever you're given tax? Because when you're calculating the amount that you're going to pay for tax, you have to calculate the total amount minus depreciation, then you get the taxable amount. From the taxable amount, you pay tax. That amount of tax is an actual amount that you'll take from your bank to KRA. So because we want to know how much did you actually move from your bank, we have to bring the element of depreciation to help us understand how much to be paid as tax. Once you have paid it, once you have removed it from our account, we now return back what we had assumed as an expense, but it wasn't an expense. That was depreciation. Depreciation is just an imaginary cost. It is not actual money that is leaving your account, but it helps us to calculate the actual amount that will leave your account in terms of tax. And that is why whenever you're given tax, depreciation becomes relevant. It becomes relevant. When you don't have tax rate, depreciation is irrelevant because that money has actually left the account. So if you subtract it, then you remain with the balance as cash flow. You are lying because it didn't leave your account. It didn't leave your account. So you understand that whenever you're given tax, then now depreciation is very important. If you're not given tax, depreciation is not important. Don't even calculate. We are calculating this because you have been given tax, 30% tax. Now, we have that. The next thing is now how to get the amount that we want to tax, that amount that we want to tax. We are told that we are going to get the profit because we need to take the revenue minus cost, minus depreciation, then we tax it, then we add back depreciation, and we shall be able to see. So let's look at how we get the profit. Keep this one in mind. I'll wrap mine. In normal classes or in accounting, we normally take the profit income, which we call revenue, minus, so the revenue will be there, minus cost, which is the operating cost. You get what is called operating profit or gross profit. Which is there. Then you minus, you less fixed cost. This is a normal operating cost. Fixed cost, you're going to have an amount there. Yes, this one can be operating profit or just call it gross profit. Then we have now operating profit, or you can also call it gross profit. I don't know how you can do it. Those accountants, they know. Let me make it easier for you. So we have the variable cost. This one is variable cost. And then we have the fixed cost. Then now we have our total gross profit. Then we minus depreciation. We have the amount there. Then now you minus the answer that you get, you do what? Minus tax. Less tax. So we're going to have that amount there. Now remember that we have taken the revenue, total revenue, minus total variable cost, minus fixed cost, minus depreciation. If you have interest, you also need to less it, minus interest. Then the amount that you're going to remain with, you need now to tax it. After taxing it, you're going to have what is called net profit. Net profit. But ideally, how much left your account? We know that depreciation didn't leave your account. That is just an imaginary. It is not money that you paid anywhere. But you have included it as an expense so that you can arrive at tax. We know that tax you paid, this one left the account, this one's left the account, but this one didn't. But we want cash flow. We want to know how much cash is in your account. So we shall allow you to remove this and remove these ones. But we shall not allow you to remove this because you are lying this amount didn't leave your account. So because you are doing this for the purpose of taxation, the amount that you got here, the amount that you get down here, the amount that you get down here, you add back depreciation kwa sababu haikutoka kwa account yako. This is just virtual figure. It didn't leave your account, lakini tulitoa. So we add it back so that we say the truth. How much we have spent in terms of actual money going out. So that means that you need to remove this, tax it, and then add it back. Whatever figure that you're going to get here is now what we call cash flow. The figure that we're going to get here is now what we call cash flow. So that is the secret. Therefore, you need to ask yourself, how do I get or arrive at the profit before tax? Then you tax it. That is just an illustration. So let's do it practically. So we start with our profit. Our profit in the first year is 600 because there is no increment in the first year, minus 400, that is the cost. The profit is 200. 200. That is 200 is our profit before depreciation, interest, and tax. Before depreciation, interest, and tax, it is 200. But because we don't have tax any interest anywhere, so we can call it before depreciation and tax is 200,000. What we have not removed here, and we shall remove, is the depreciation and tax. So you say tunatoa depreciation kwanza and then tunatoa tax. So less the depreciation. Depreciation we have calculated in how much? 140 every year. So this year, the first one we remove 140. Then we have our profit before tax, because depreciation to shatoa. It is going to be 60,000. Then we say less tax at 30%. Less tax at 30%. So 30% of this amount is 18, right? Eighteen. Now we are saying that our profit after tax, which is saying now profit after removing tax, is actually 42,000. Are we together up to there? So you add back depreciation kwa sababu we only brought the depreciation element for the purpose of taxation, but it is not actual amount that left our account. It is not actual money that left our account. So we add it back so that we say the truth, that we only paid this out of this amount, out of this, ile pesa tulilipa ni tax peke yake. Hii tuliweka tu so that we can calculate. So we add it back because we still have that money in our account. So add it back. So add back 140, which is depreciation. Add back depreciation. 140. Remember, this knowledge you will apply it whether it is in sensitivity analysis for break-even or impact. As long as you are given this information where there is tax, and you are told that there is a scrap value, or they tell you that there was a depreciation, just know that you are going to use this information so that it can allow you get the cash flow. So it is not special for break-even point only. It is just a normal way of getting a free cash flow. So we are having 162,000. 162,000. 162,000 is now our free, we call it free cash flow. That is money that you can go to the bank today and just remove it and do your business. Haina shida, iko hapo inakungojea. 182, thank you. 182, thank you. So we have 182,000. Is there a problem up to there? Kuna mtu ako na tashwishi? Kuna mtu ameshtuka? Or can I assume that we are all fine? So I'm assuming that we are okay because there is silence. Silent means that you don't understand. Silent means that you're also okay. Silent can also mean that you agree. In this case, your silent means that you're okay. It will mean that you're okay. So we have our cash flow for year one. That is the first year. So we are done with the first year cash flow, which has been given like that. So we can be able to calculate our NPV. They are saying that for each of the 3 years, usage the equivalent, the equipment expected is expected to increase both sales revenue and operating cost by 600 and 400 respectively. So that is the first year cash flow. The second year, we are going to increase that cash flow so we can move again. So year two. In year two, our profit will be 600 for the first year and another 600 for the second year. So we are going to increase the cash flow by another 600. So we're going to have total of the first 600 plus 600, because in every year we need to increase it by this. So we are going to have that minus the 400 which was there before plus 400, which has got 1200 minus 800. So our profit in the second year is going to be 400,000. Our profit in the second year will be 400,000. That is just the cash flow. We have not added the scrap value. Somebody is asking, cash flow, we are okay. Are we not adding the scrap value? Scrap value is on the third year. We are in second year. We are in the second year. Or let me just make it easier for you. Instead of adding it manually, let me just make it easier for you so that you guys can understand.
No, Mr. Dennis, you see, if you're going that manually, it's easier for us to understand. We don't need a shortcut. There are people who just need it to do it manually.
Yes, Florence, I second you.
So you want us to proceed manually like that?
Yes, just do manually. We go proper. Taratibu tu.
Okay.
Hi, was
In year two, we have an increase of 600. So we're going to have total of 1200,000 minus 800,000, which is equal to 400,000. So therefore, our cash flow for year two will be 400,000. So we have profit before depreciation and tax, which is 400,000 less depreciation, which is how much of depreciation? 140. Right? So you're going to have profit before tax, which is how much is that? 260. which is 260. And then we have confirmed that is the correct figure. We now have less tax at 30%. 30% of 260 is how much? Somebody can get us that one.
$78,000.
78,000. So how much are you having as there? How much are you going to have there as the final?
182.
How much?
182,000.
182. 182,000. So that is their profit before tax. No, after tax, right? After tax. Profit after tax is 182,000. Now add back depreciation. Depreciation is 140, right? So we are going to have 322,000, right? Confirm that is a cash flow. Free cash flow. Free cash flow. That is okay. So that is year 2 cash flow. Let's go to year 3. Let's get cash flow for year 3. Cash flow for year 3. So in year 3, that is another increment of 600. So it was 1.2. Now we're going to have 1.8 minus 400 times 3 is going to be 12, right? So our profit will be 600 this time. And we're saying that profit before tax and depreciation is 600 less depreciation, which is 140. How much is that? That is 60. That is 460. Confirm. So less depreciation. Then that is profit before tax now. Then we have less tax at 30%. How much is that? 30% of that? That is 118. Can somebody calculate for me tax 30%?
$138.
138. So if you subtract this, that is 2, 2, 3. Add back, that is profit after tax. Add the depreciation. Add back depreciation. So depreciation is 140. What are you going to have? That is a free cash flow in year 3. Free cash flow in year 3. free cash flow in year 3. Now, so we have our cash flows. I tell you that this kind of cash flow changes every year. There is an increment every year. An increment every year. So that means, is it 164? I think that is the correct figure. I'm seeing some people typing. I'm not sure. I hope it is the correct figure. Now, our cash flow for every year, you can be able now to get NPV. We have cash flow there, which is then we have discounting factor. Then we have the NPV, right? So in year zero, there is no business that you're doing in year zero. Year zero is normally for expense only. So in year zero, you spend 500,000, right? The cash flow was money going out, money spent. So in year zero is normally that. In year zero, discounting factor is normally 1. If you take a number raised to power 1, is normally power 0 is normally 1. So therefore, the NPV here, you put that figure the way it is. In year 1, our cash flow was how much? 182. In year 2, our cash flow was 3. Was it 322? Give me the cash flow for year 2.
322.
322. And then year 3, the cash flow is now 462. If they keep on increasing every year, then the discounting factor, you can also put them there. Now, here is where you bring the scrap value, because you're going to sell it in year 3. So the same year 3, now the scrap value is 80,000. So you put it there. The discounting factor for the cash flow in year 3 shall be the discounting factor for cash flow in year, for the scrap value in year 3, right? If the cash flows are irregular. Now, let's proceed. We have now discounting factor. We were given 10%. So what is the discounting factor here? We are using PV. Why? Because they are irregular cash flows. So if you're going to use PV, we take 1 plus R into negative N. So tell me year 1, what is it? Year 2 and year 3, discounting factors. Go ahead. What is the discounting factor?
For year 1, Mwalimu,
Yes.
0.9090.
Cannot be 9090. Check well.
We round it off.
Hiyo figure unaona hapa, is it more than 5 or 5 and above?
9091. Naam? Yeah, 91.
Thank you.
Weki hiyo. Yes.
The second one, 0.8.
8265.
Are you sure?
Yeah.
Okay.
0.8265.
The second one, 0.7.
0.8. Oh, the third one.
The third one, yeah.
0.75. 13.
Not 1, 2.
13.
I said that the scrap value is normally the same as the discounting factor for year 3. So the discounting factor for scrap value is the same as the discounting factor or PVIF. PVIF for the last year. The last year, it can be 10 years, so it is for the last year. 8264. I believe this can be okay. 64, I doubt 65. I've not done it, but I don't know why I doubt 65. I've never seen something like 65. I've seen a lot of things in life, but 65. Confirm again. Guys, tuko wengi, tunasaidiana. Sasa Ruth,
64 is
ukiona Ruth and Waziri wana collide, kuna mtu anafaa kuje katikati aseme ukweli. Haraka haraka ndio tusonge.
0.2864 is correct.
64. Waziri anasema 1654.56. That is the total for the first one. So the Edwin is saying 64. Ni pia naona hivyo. Haya. So Waziri, in terms of rounding off, be very careful. Imagine you miss this one only, you spoil the whole story. Then you blame yourself or the teacher. Hii peke yake itakuangusha. Alafu unasema hii pepa ilikuwa rahisi, hata sielewi kwa nini. Kwa nini? Na mwalimu alifanya yake na mimi pia nilifanya yangu. So be careful on those things.
How did you miss that? It is 644, so you can't round off.
64?
Nasema ni 64, si 65.
Oh, thank you. Haya, year 1, 165. Waziri amenipea 165, 456.2. 165, 460, 456.2. The next one. Fanya haraka haraka. Fanya haraka haraka. Year 2 is 266. 100.6. The next one. 347. 100.6. Is it the correct figure? Yeah, 347. 601.04. 601.04. 666, sorry. It should be 601.04. 601.04. So that is 60,000, right? Okay, add all this. Add all this and you get your NPV. So whenever you have irregular cash flow, irregular, meaning that they're not the same, always put them in a columnar form. Each year separate. Get their discounting factors separate because the cash flows are not the same, and use PV. So the total should be 838, 761.6. So, okay, so that is it for getting NPV. If the cash flows were increasing every year, inaongezeka, ina double, right? So that is how you are going to increase them. Somebody is getting 3. So sorry, it should be 3. 761. Okay, no problem. Thank you, no problem. Now, let us look at question number Roman 2. Say, calculate NPV calculate NPV, assuming, calculate NPV, assuming the project, calculate NPV, assuming the project, calculate NPV, assuming the project will provide annual cash flow of 182. Assuming that the project will give an annual cash flow of 182 of 182,000 for 3 years. 182,000 for 3 years. Assuming that now the cash flow is going to be constant, regular for 3 years, and every year is 182,000. So how do we go about that? There is no increment. Every year there will be an annual cash flow which is the same. Every year the same for 3 years. That is now regular cash flow. Are we using PV or PVFA? Assume a regular cash flow or an annual cash flow of 182. PVFA, thank you. So if it is PVFA, we normally say that NPV is equal to the cash flow times PVFA at a certain rate for certain years plus this plus scrap value. So scrap value minus IO. Scrap value minus IO. In fact, we are saying that minus, we have PVFA or PV times scrap value. So that means, therefore, that we need to look at the cash flow, which is regular. So our NPV will be 182 times PVFA is how much? What is the value of PVFA? What is the value of PVFA? Somebody saying it is 2.4868. Yes. So you use the formula for PVFA is, it is 1 minus, in bracket, 1 plus R raised to negative N all over R. Right? That is the formula. So when you use that, you're going to get 2.4869. Right? So this one, you add plus the scrap value is PV. Get me the scrap value. What is the value of PV? PV. So PV, the scrap value is in third year. So use PV for third year. Don't use for first year. We are going to sell it in the third year. That is when it is scrap. When it is scrap. So use for third year. Zero. Thank you so much, Florence. So that is 0.0 7513. So we have 80,000 times 0.7513 minus IO, which is 500,000. So can somebody get me the whole figure? What are we getting? Silent, please, silent. So 1270, 12,719.8. That is a figure. All right. Now, this is our NPV. This is our NPV. Let's look at method 2 of getting the same NPV. That is method 1. Call it method 1. Call it method 1. So we have method 2. Why are we going for method 2? I want you to understand. When we use method 1, there was something that you can miss out or can be difficult for you to work with. Because in method 1, you're being told that NPV is equal to the cash flows. And you know the component of cash flow is revenue minus cost minus the depreciation plus minus tax plus depreciation. Then you come to cash flow, which is 182. Now, when you have it here, ukiwa nayo kijumla, when you have it as a combined figure, you'll not be able to vary elements. So we have these elements, or what we call variables, which you can be told to vary. Perform sensitivity analysis when varying revenue, when varying cost, when varying maybe depreciation. How will you vary them when all of them are here? So that is what is now taking us to the second formula, where we are trying now to break them into different components so that we can be able to understand and be able now to vary them using method 2. So we can still vary it using, we can still now calculate NPV using method 2. So let's look at method 2. So method 2, we are saying that NPV is equal to profit before depreciation and tax into bracket 1 minus tax plus a depreciation tax shield. This one we call it depreciation tax shield. A depreciation tax shield. So what did we do? We took the profit before depreciation and tax, which is 182,000. No, it was how much? Profit before depreciation and tax was 200,000. You remember? It was 200,000. Then took a total tax. Then we added back depreciation. So instead of taking this value, you remove depreciation and then you add back depreciation. You just take depreciation and add the tax element. Wakati uli minus depreciation, ulikuwa unajaribu kuhepa tax that could have been charged on that depreciation amount. Hiyo ndio ulikuwa unajaribu kuhepa, si ndio? And that is why you took this amount, you subtracted 140, ukabaki na 60, you tax 60, ukahepa tax on this, So therefore, how much tax have you heaped here? Umehepa tax of how much? It is 30% of this. We call that amount of tax that you escaped a depreciation tax shield. That is the advantage. So here we are taking the full amount, which is 200. We are taxing the whole of it, and then we add back the amount that you should have escaped were you to go through this process. We add back the amount that you're supposed to escape, and that was 30% of this. This is what we were supposed to escape. We call it a depreciation tax shield. I'm repeating. Normally, you are supposed to come and take profit before tax, which is 200, minus depreciation, then get the balance, tax this balance, then add back the depreciation. What are we trying to escape? We are trying to escape the amount of tax that could have been taken from here. If you were to leave it, they could have taxed it, and we could have paid the government amount 30% of this. Lakini tunajaribu kuepa, ndio maana tunatoa kwanza, tuna tax, kisha tunarudisha, tumeepa tax. Now, if we take the full amount the way it was here, 200, then we tax it, hatujaepa tax. So we say, how much were you supposed to escape? It was a percentage of this. So we know it has gone, we add it back. We know it has gone when it was inside here. It has been taken, we add it back, and that is why we call it the depreciation tax shield. Tax shield. It is the amount of depreciation that should have been shielded from tax. So I hope that you understand the reason why we are doing this. So this is another formula. So here we are going to have our figures, and you can calculate. Now 1 minus tax is 30%. 1 minus this is 0. So we have 200,000 times 0.7 plus 140. Depreciation was 140 times 30% that we were supposed to escape, which is now 0.3. How much do you have here? How much do you have there? Here in method 2, for hivyo, the answer that we're getting should be the same as the method 1 answer. How much are we getting there? That is our, not NPV, but this one is cash flow, sorry. That is how we are calculating our cash flow. NPV, you know, we have cash flow now times whatever. So our cash flow, CF, can be broken down in this way. So can you get me the full answer if it is going to give you the cash flow that we got, which is this one? $182. And 182 was our cash flow, senior, when you use the normal formula in year 1. Hii ndio figure tulipata. Si kweli? So we are now safe. We can now confirm that this one is a cash flow. Now, if we decide to expand this formula, instead of writing cash flow as CF, we decide to expand it like this, it is possible. Because we have confirmed that this one, ikiwa hivi, it is the same as CF. So instead of having our CF times the PVFA, we now have the whole of this times PVFA. Does it make sense? We have verified that cash flow can be gotten through this, which has confirmed 182. Instead of having 200 minus depreciation, tax, add back, we've decided to go through this route, and it has confirmed to us that we can still arrive at 182. That is for year 1, yes. That is for year 1. And remember, we are told that assume that the cash flow was only 182. How did we get 182? Using the information that we had, we use the formula for year one. So meaning that we are seeing that that cash flow for year one ndio imekuwa throughout. So in question 2, they were assuming that that cash flow, which is 182, which is the same as cash flow for year one, ndio tumekuwa nayo throughout. So that therefore means that if that is the case, we can get that cash flow using this formula. So now we can use now this one and get our same cash flow in Roman 2. Now, if this cash flow is there annually, as guided by Roman 2, we can use this other formula to get our NPV. How do we do it? We say now that NPV is equal to how did we get the profit before tax and depreciation? It was revenue minus cost, which is 600 minus 400. That is this. Then the answer that we got, which is now the profit before depreciation and tax, we multiply 1 minus t. Then we added the t to the answer. That is what we did. Now, this one is basically cash flow. It's the same as this. So this one is cash flow. So we are saying that all this cash flow, which is basically CF, we can now have it here, multiplied with PV. Then whatever answer that you're going to get, add PV of the scrap value minus IO. The scrap value minus IO. So we have expanded the CF that you are used to. We now look at what is the component of that CF. We have proved through this one that this formula can bring a CF, which is the cash flow. And so therefore, we know that is the CF times PV bar. Therefore, we are having the whole figure times PV bar plus PV times the scrap value minus IO. We can now proceed and confirm if it is true that we shall get our NPV as you had seen in method 1. So we come and say 600, that is R, minus 400 times tax, which is 0.7, plus depreciation tax shield, which is 140 times 0.3. All this you multiply with PV, which was 2.4869. The answer that we shall get, we have just done it up to here. The answer that we shall get, we add our scrap value, which is 80 times PV. PV for year 3 was 0.71. 0.71. 7513. 7513. Then now we minus IO, which is 500,000. Those who can do calculation kindly confirm if our answer is the same as 12 that we got. The answers should be the same as 12. 719.8. Is this the same as what we got in year 1, in method 1? Prove. If it is wrong, you tell me. If it is not the same, you tell me. Kindly confirm that is true. Great. So you guys have confirmed that is true. Now, if it is true, for the purpose of sensitivity analysis, because we are going to vary them, because of the purpose of sensitivity analysis, and we are going to vary them, it is better we use this one because you can clearly see what to vary. You can change them. Ile ingine ilikuwa nasema tu CF and you don't know how to vary them. You cannot separate them. So let's proceed now. Let's now go to, we have confirmed and we have performed NPV. Now, or calculated NPV. Now let's do sensitivity analysis. Roman 3. Carry out, right, Roman 3, carry out sensitivity analysis of the cost of equipment. Carry out sensitivity analysis of the cost of equipment. Carry out sensitivity analysis of the cost of equipment. Scrap value and sales revenue. Scrap value and sales revenue. The cost of equipment, scrap value and sales revenue. Sasa, tukitumia ile method 1, hatutaweza kuseparate so that we can vary the cost, we can vary the sales revenue separately. At least scrap value we can because it was splitted, it was away. Lakini hizi zingine zilikuwa pamoja. We have to break them ndio tuone gani kati yao tuna vary tukiacha mwingine constant. So that is why we have to use method 2 because it is the one that clearly separates them. Tuko pamoja? Okay. Now, where do we start from? Who can tell me? So we are told to vary something. So say sensitivity analysis of equipment, of cost of equipment. Sensitivity analysis of cost of equipment. That is Roman 3. Sensitivity analysis of the cost of equipment. So that is Roman 3A. Roman 3A. So you say that let the cost of equipment equals X because it is the one that we want to vary. What are we doing here? We want to look at the cost of equipment that can make NPV 0. Tuko pamoja? We want to look at the cost of equipment that can make NPV become 0. Because in break-even analysis, our main aim is to look at the variables or to vary them such that the cost, the NPV becomes 0. Look at what we say. Break-even point sensitivity analysis, they are trying to ascertain the change in a variable. In this case, the variable is the scrap, the cost. Another variable is the revenue. Another variable is the scrap value. So we need to look at a change in a variable that will push the NPV of the project to 0. So we don't know that change that we need to make. And so the variable that we're going to look at, because we don't know how to change it, we can call it X. So you say, let cost of capital be X. Let the cost of capital be X. So that we can say that our NPV is equal to revenue which we know. Revenue we know ilikuwa ngapi? In the first illustration 600, sio? So it was 600,000 which has given us the 182, sio? So it was 600 which we know minus X now, because we don't know this is the one that we have to vary into bracket 1 minus T plus dt. All these you have to multiply with PV, which is 2.48, 2.4869, 2.4869, plus now the scrap value. The scrap value we have calculated, and I think we know it. It was 80 times 0.7513 minus 500,000. Minus 500,000. I thought the cost of machine is the initial cost. I thought the cost of machine is the initial cost. So what is the examiner saying? The cost of the machine, not the running cost. Carry out sensitivity analysis of the cost of equipment. Yes, you are right. The cost of equipment. So it is the one that we have X. Cost of equipment, not running cost. So we have 600 minus 400. Then now we have the cost of equipment to be X. Bado iko tu sawa. Hata kama tukiambiwa tubali tunaweka tu X. Now that tumeelewa, it is supposed to be cost of equipment and not the operation cost. So if it is not operating cost, then we now have it like that. So we have this one 200 times 0.7 plus dt 140 times 0.3 times 2.4869 plus 80. So because we are saying that NPV is equal to 0, then now you equate whatever you are having to 0, because NPV is 0. So hapa itakuwa 0. In sensitivity analysis, look at the statement. We are not told the percentage change. We are told that carry out sensitivity analysis of the cost of equipment. They are silent about the percentage change. So it is up to you to know that this one is not impact, kwa sababu hawajatupea the percentage change on each variable. Wametuambia tu sensitivity analysis of the equipment cost. Therefore, it should ring into your mind automatically that this one can never be impact analysis. It can only be the opposite, which is the break-even point. Now, after understanding that, we are saying that at break-even point NPV is 0. So you say that 0 is equal to this figure. So we have here 0 equal to all these figures. So this is 8 times 0.7513 minus X. So X is negative. X is negative. When it passes equal sign, it becomes positive. So you can say that X is equal to whatever answer that you're going to get here, that is 140 plus this one times this for 20, or is it 42? 30% of that, 42,000 times 2.4869 plus, I don't know what is the figure here. This one. Umeelewa? Hii ni negative. If you bring it on the equal side, it becomes positive. It is just the same as if we could have this one is equal to 0, then now it crosses the other side, but only positive. So it is a positive figure. So this should make sense to you. Please don't mistake it. we had an option of making this 0 equal compared to 7. All these equal to 0. Therefore, x can cross 0. If it crosses, it becomes positive. So it is the same. So let me calculate my 80,000 times 0.7 513. That will give us 6104. So that is the value of x. So let's get the value of x here. And that x will be there. That x will be the cost of the machine. Now, if you add this one, unapata ngapi? Somebody to help me here. Mi nikiadi, naona ni kama 182 times 2.4869 plus 6104. So my worry is now how to calculate this. Hiyo ndio naona kama ni ngumu. So we calculate 182 plus 6014. So you're having who is trying like giving up, or who is being attempted to give up? Who is trying like giving up? Or thinking like giving up? When you look at this thing keenly, there is something that you are going to see. That we have 500, and then we have 12.719. And this 12.719.8 was the profit. See, ndio ilikuwa profit, NPV. Lakini 500 was the cost. So tunasema, hii machine, ukiongeza bei yake, such that bei yake imekula profit, then we are not going to make any profit and we are not going to make any loss. So the cost of the machine has become both the original cost plus the profit. It is the total of profit and cost. At that point, you cannot make any profit because imekula your profit. So you can always know when you're doing exam whether you are right or not, because you just look at the machine and say, enyewe, kama hii ilikuwa profit na imekuwa part of the cost, hakuna profit tutakuwa nayo. It makes sense. So if you come and get your answer as 521.7, you are wrong. You are wrong because we have never had this profit. In fact, the original NPV that you got should tell you, guide you whether you are right or not. So bei ya machine imekuwa juu, imekula hadi profit plus ile bei yake ya kawaida. Are we okay? Waziri, does it make sense? Let's now vary it. Let's now talk about the percentage of adverse change. Is it adverse or it is positive change? This one. Is it adverse or it is positive change? The cost has gone up. It is not positive, Ruth. Kwa sababu, we are looking at the cost of the machine. Initially ilikuwa 500, lakini sasa hivi tunaona imekuwa 512. Imeenda juu. Cost ikiwa juu, mambo ni mbaya. Maneno sio gazuri. So we have to say it is adverse change. So you say that percentage of adverse change is equal to the new minus all over all. Of course, these are NPV. So just say we have 512.719.8 minus 500 all over 500. What is your percentage? You tell me. Somebody has gotten it to be 2.5. Thank you so much. So you're having 2.5%. That is a percentage of adverse change. Ignore the negative because already you have mentioned it is adverse. So you don't need to put the negative sign again. And if it was positive, just say that percentage of change. Percentage of change, we know it is positive. Or you say percentage of favorable change. Let's now move to the next part. That is how you do sensitivity analysis for break-even point analysis. Let's look at how we can vary time here inaenda. Let's now vary our scrap value. And I won't move sana because already we know what we want. I'll just come and now make scrap value. We are told the scrap value and we are told to change the scrap value and then sales. So scrap value was 80,000. So let's let 80 be X. Let 80 be X. When now we know, you change them one at a time. So we change the X, but this one remain now 500. Tunaijua. Kenye hatujui ni X sasa. The rest remain the same. I wish I didn't even wrap the other ones, but it's okay. It's okay. So we have 182. 182,000, right? Plus, no, times 182,000 was up to here. Zero. Times 2.4869. Is it true? Plus, now we don't know X. This one is now X. We now call it our X. So we have X times, in fact, we have 0.7513X minus 500,000. That's not what we have, right? In the also to do, so we come and say 0.7513X is equal to 500,000. See, 500,000 even cross equal sign. When it crosses equal sign, it becomes positive. So it is a positive figure. So get me the figure here. What is this? When you multiply this, what do we get? So that we have 0.7513X is equal to 500,000 minus the answer that you're going to get here. When it crosses the equal sign, it becomes negative. Now get me the answer. I can do that because I know you might chelewa, so I can do it times 2.4869. So we are having our 452,615.8. I can't allow you to chelewa me, chelewesha me here. I'll do it and then we move on. You can't chelewesha me. Imekata. So minus 47, 384.2. So that we have X. This one, when it comes this side, inafanya nini? Divides, right? So this one divided by 0.57513. So we have 63,069.61. That is it. So we are seeing that now the scrap value has moved from 80,000 to 63,000. Is it a good thing or a bad thing? Is it a good thing or a bad thing? If it is a bad thing, adverse. If it is a good thing, just favorable. Adverse or favorable? The scrap value has gone down. Scrap value was part of our income. ni kuuza. Sasa ile metal unataka kuuza bei yake imeanguka. Ruth, is it adverse or it is favorable? Thank you. So we are saying that our percentage of adverse change is equal to the new, which is now 63, that is a new 069.61 minus 80 all over 80. Remember that you are looking at the change, not change on NPV like the previous one that we are looking at. The other one was change on NPV. Sorry, I wrote change on NPV somewhere. It is not change on NPV. It was change on the cost of the metal. That is why we used 500. Even this one, we are looking at the change on the scrap value, not NPV anymore. But we're looking at the change of these variables that can make NPV 0. The change of each variable that can make NPV 0. So if, in any case, in the first sensitivity that we have just done on cost of equipment, you've written percentage of adverse change on NPV. Kindly change so that you say the percentage on adverse change of the cost of the machine. You know, inafaa ieleweke, inafaa uelewe kwa nini tunafanya vile tunafanya. Let's do the last one and then we can go and see. Time imeenda very fast. So we are again going to make some changes, but not all. Let's look at the sales. You can now vary the sales, right? Now, percentage change of sales, we have to vary the sales, which is this one. That is what examiner asked. They said the sales revenue. So we are dealing with this, leaving others constant. So we are not going to have a direct figure like this. We are going to say that now our figure looks like this. We are now having X. So let this be the X. For sales, you say let sales revenue be X, so that we have X minus 400. The rest are okay. The rest are very okay. So we have our X minus 400. So this one is going to be 0.3, right? So we have 0.3X minus this one times 3. See, that's 7, sorry, 7. 1 minus 30% is 7, so we're multiplying with 7. So it is 0.7x. This one is going to be 280. Confirm kama ni kweli. 7 here times this. Is it 280? Should be. The rest are okay, right? And then we come here and now change this so that we have the correct figure 80,000 times 0.7513 minus 500. So just give it full figure because now we know it. So this one is not X anymore. It is 80,000. We call it by its name. We call it by its name. So that we only have this one as X. The rest of the thing remains constant. This one here is the same. This one is still the same and everything else. So we have that. Is there anybody who is confused now? Do you understand how we arrived here? We just made the cells which was 600X. The rest have remained the way we know them, the way they are known. Because we agreed in sensitivity, you vary one at a time. In sensitivity, you vary one at a time. 280. 400 times 7. Was it 40 or 1? 400 times 0.7 inakuwa ngapi? What is the correct figure? Waziri, we were just supposed to take this one minus this times 1 minus t. T is tax, which is 0.3. So 1 minus 0.3 is 0.7. 0.7 times this, 0.7 times this. So hapa is 0.7x. But in this side, it is 280 because it is 0.7 times 400. Ni ukweli ama uongo? What is the correct figure? Not quitting. Is that you who has texted? Yes, you are saying it is 280. Ni ukweli. Iko sawa. Correct. Thank you. Waziri amekubali. Thank you. Now, we now have this. I hope hakuna mwenye amepotea. I hope hakuna mwenye amepotea. Na kama umepotea, usiogope. Ukiogopa saa hii, utaogopa kwa mtihani pia. If you don't want ask now, because unaogopa, utaogopa zaidi kwa mtihani. Sawa. So sisi tumefika hapa. So we are having these figures. We have actually multiplied this, so hakuna any box again. So we just add all this. Now this is supposed to be multiplied. So we are having 0.7x minus 280 plus 42. This one was 42,000 here. Right? Yes. So all this we are supposed now to multiply with 2.4869. Plus now, when you calculate those two, what were we getting? This is my calculator. 80 times 0.7513. So that was 60,104 minus 500. All this equal to, all this should be equal to 0. All those should be equal to 0. How do we now add this? Can someone now, sisters, calculate that? So this one is a negative 280 plus 42. We are getting negative, so we have 0.7x minus 238,000 times 2.4869 plus 60,104 minus 500 is equal to 0. Right? So multiply for me this upper. What do you get? We are getting 0.7 times 2.4869. 2.4869. That is 1.74083 x minus this times this 283,000 times 2.4869. We are having 79 2.7. Then now minus 500 is equal to 0. Right? So what are we doing? All this can cross the equal line, equal signs. If they cross, they become positive. So that we have 1.74083x. This one can cross and this can cross. Kwanza, if you add this and this, what do you think you can get? It's a negative minus negative, positive. So it is total point something. What is the figure? When all of them crosses, kuna figures they add up. I was almost forgetting this one, right? So there's a figure there that I'm almost leaving out, I believe. Did I calculate them correctly? So you're having this one plus 60, 104 minus 500. I was almost forgetting this. Ebu calculate kama ni kweli iko hivyo. If it is like that. This. Wale wa hesabu unapata ngapi? It's 500 plus 7, 3. How did you get 74? Get for me the correct one, because I'm just trying to I'm trying to say that this minus this. What do you get? This plus this unapata. What is the correct figure? Mwalimu, 360. You guys are helping me. 238 times this one is 591. 238. So 238 times this is 591, not 7. Thank you. So you are saying that I need to repeat and say 238,000 times 2.4 869. So now, thank you so much. Just that. So that I just change this one. So we have 591, 8, 8, 2. Let me ask you guys. Sasa vile tunafanya hapa, we are making notes and writing them. We are doing it practically kwa board na tunatengeneza notes alafu we are writing. Alafu mwanafunzi anakuja ati kindly share with me notes for AFM. Where do I get notes if you are not in class to make the notes? Tunatengeneza sahihi, mtu anaitisha nataka notes za AFM. Mimi nitoe wapi? And we are doing it with you when you are in class. Sio kama theories. Theories you can prepare and share. So what is the answer? So that one plus 500 minus 60, 104. Sasa mimi napata 103,178.2. So x is equal to 103 778.2 divided by 1.7 4083. So that one divided by 1.7 4083. So we are getting 5. What are you getting? When you divide this two, what are you getting? 592, 703. 592, 703. So 592, 703. Topi, unacheka. Mtu anakuambia mwalimu, I just need notes. Mimi nataka tu notes peke yake. Mimi nitoe wapi? Nitoe wapi na nyinyi ndio mko na answers. So, that is the figure. So we are saying, what are we looking at? The revenue. Revenue has moved from 600,000 to 592. Is it adverse or it is positive? Adverse or positive? Then we can conclude and say that percentage change, because revenue should increase but has gone down. Percentage adverse change is equal to the new, which is 9703.47 all over 600 minus 600 here. So the answer is what? $592 072.47 minus 600 divided by 600. Inapata 1.22%. 1.22%. It means that if we just change the revenue, ikienda chini kidogo na 1.22%, we are not going to make any profit. NPV is going to be zero. So we are done. Thank you so much. That is all about the sensitivity analysis. I want you to do an example, and then you share with us on WhatsApp an assignment. Assignment, past paper. Let me check which setting. Somebody to share the past paper questions. Try November 2019 assignment, and I will mark it. November 2019, question number 1, B, and C. November 2019, question number 1, B, and C. November 2019, question number 1, B, and C. So you guys need to check on that and let me know what you have seen and how you can go about it. It is a sensitivity analysis question. I will not tell you which one it is, but I want you to try and do them. I can now unmute you so that if you have any question you can ask before I leave. Thank you so much for being patient. Wale watu wa kelele, sasa niwafungulie wapige kelele. Kelele mtakatifu. Wako wapi? Hadi wale wa kelele mtakatifu. How do I do it? Bwana ananisumbua. To make nice. Yes. Can now make nice. You want me to stop recording first so that you make nice. Sawa.